Hey, good morning, everyone. Thanks for coming out on this foggy morning. So, do we have a clicker? We do. We're going to keep this relatively informal. I think I've got maybe 15, 20 minutes worth of slides. I'll get through those very quickly and then reserve 15 to 20 minutes, whenever Chad pulls me off for questions and answers. Just ask me anything. But, we'll start with a little bit of an introduction. Who is Lightspeed? I'm not sure if I've worked with or if we've worked with anybody here in the room, but we're located down in Menlo Park in Sandhill Road. When you're fundraising, you'll get to know that street very, very well. It's the venture capital ghetto. We manage about $3 billion in capital right now across 4 active funds. We've been around for several years. We're on our 10th fund right now, and we spend a lot of our time investing in the enterprise as well as in the consumer spaces. We've been fortunate to have backed companies like Brocade and Riverbed and Fusion.io, Nest, which was sold to Google, Snapchat. None of us in this room are young enough to be using Snapchat, and a number of other companies. Yeah, we tend to be early stage investors. We primarily do Series A and Series B. We'll do some seeds, we'll do some Series C's and D's, but a lot of what we do is at the earliest stages of company formation. We're international. We've got offices here in the US as well as in India and in Israel, and an affiliate fund in China. A little bit about me. I've been there since 2008. That's going on 7 years at Lightspeed. I spend all of my time on the enterprise side, so that's why I'm not wearing skinny pants and why I'm dressed a little bit more formally. I tend to invest in areas like infrastructure, that's storage, networking, SaaS, mobile, cloud, all of the buzzword-friendly themes these days. I should put big data up there. I've done a lot of work in big data also. Before Lightspeed, I was at Cisco Systems. I was in the mergers and acquisitions group at Cisco, where I covered unified communications. And I actually started my career as a chip designer back in the late 90s. That is now an almost obsolete profession, unfortunately, but it was a lot of fun when I was doing it. So what are we going to do? So over the next, call it 20 minutes, I'm going to walk you through 2 things. One is value proposition from a company perspective and value proposition from an investor perspective. And these are sort of, they're very tightly coupled, but they're also very different in the sense that as an entrepreneur, there is almost a tendency to jump directly to investor value proposition, trying to think through, how do I create my pitch for an investor so that investor will actually invest in me? I would actually argue that it's more important to spend time on your company value proposition. And we'll walk through what that is. But why is this important? Because you need to convince yourself, your employees, your co-founders, and ultimately your customers that they should buy your product. If you've got that, then investment will follow. So let's talk about value proposition. What is it? What is a value proposition? Well, a value proposition is essentially something that helps inform a choice. From a company perspective, it helps inform a choice for an employee to join you. It helps inform a choice for a co-founder to go to war with you. It helps inform a choice for a customer to buy your product. From an investor perspective, it helps inform a choice to invest in you, to give you capital, to give you resources to help you build your company. So we're going to walk through how to build this company, this value proposition, both from a company perspective as well as from an investor perspective. So there's 5 things from a company perspective. 5. I'm going to try to get these off the top of my head. Purpose, audience, category, uniqueness, and significance. We'll walk through each of these, but this is a framework that I like to use for helping frame what your company value proposition is. If you start with company value proposition first, and you work through all 5 of these issues, and you answer all 5 of these questions, out of this will pop an elevator pitch. Out of your elevator pitch pops an investment thesis. Out of an investment thesis, hopefully, pops investment from an investor. So if you work through rigorously first your company value proposition, answering the questions of purpose, audience, category, significance, and uniqueness, then you will be able to help inform a choice for people to join you, for customers to buy your product. This is very, very important. So first, let's start with purpose. This is the highest meta level question that you need to answer. What is the product or the service that you're building? What is it? And try to describe it as concisely as possible. A big mistake that a lot of people make is it takes them a minute, 2 minutes, 3 minutes, 5 minutes to actually describe the product or the service that they're building. If it takes you that long and there's that much of a preamble, then it's very, very difficult for anybody to inform a choice. Get it down to almost 5 to 10 words. Here's what I'm building. What is it that I'm building? What is it a product? Is it a widget? Is it a cloud service? Is it software as a service? Is it a consulting company? What is it? This is super important, and this is the meta level question that you need to answer. Next, who cares? Who are you selling to? So now you've come up and you've answered the question around what is it that you're building? What is it that you're selling? Now you need to answer, who are you selling to? Who's going to buy this product and why will they buy this product? Out of answering your question around your audience, you're actually going to help inform how large is your market size? How much can I charge for this? Why will they buy? Who do I market to? How do I describe this to the right person? If you could identify what you're selling and who you're selling to, you're 40% there. And in many cases, this sounds completely obvious, but in many cases, people come up with technology first and then try to figure out who they're selling to. Technology looking for a problem is, in my opinion, a very, very dangerous place to be. So if you come up with what you're building and who you're selling to, you can inform, is the market size large enough? This is something that investors really care about. Will these people pay? And what do I need to market? How do I market these people, and how do I get them to open up their wallet and give me money? Now that you've figured out what your purpose is, what your audience is, you also need to figure out what the significance is of your product. What are the benefits, the pros and cons of your product? Is this a vitamin or is this a painkiller? Is this something that someone would take once a day and that has an ongoing, call it annuity, or is this something that people will only use when they're absolutely in pain? What are the benefits of this product? So what is it I do? Who am I selling to? And what are the benefits? What are the key benefits? And as you're thinking through the key benefits, you should also think through what are the cons also of your product? Because someone's going to pay you, someone's actually going to there's opportunity costs associated with your product or your service. Let's be clear, product or service. So now you've got your purpose, your audience, your significance. You've talked through what you're selling, who you're selling to, what the significance is, i.e. what the benefits are of your product. Now think about the category. There's some subtlety here around audience and category, right? Audience is who you're selling to. Category is really a question about what the economics are of the category, who the competitors are within your category, what the gross margins might be within the category. Let's give some examples. Consulting companies tend to sell for, and at exit value, 1 to 2 times sales revenues. This should inform how large a company you need to build. Product companies, if they're in the SaaS space, tend to go for 10 times revenues in the public markets. That's a huge difference in multiples. There's certain categories that are commodities. Oil. If you're in the oil business, you've just witnessed the price of your oil, the price of the commodity you're selling drop 50% in the matter of 6 to 7 months. If you're in the software business, gross margins can be much higher, 85, 90, 95% gross margin. So it's very, very important to understand not only the audience, which informs market size, but also the category that you're competing in. What are the market dynamics in and around the category, and what does that mean from an economic perspective? How will that inform gross margin, and how will that inform operating margin? Which then leads to how you can actually build your company. And finally, uniqueness. Who do you compete with? You need to understand this. If there's no competitors, then there's probably no market. The biggest mistake I hear entrepreneurs say is, I'm completely unique, I don't have any competitors. Well, if you have no competitors, there's no audience, which means no one's buying anything in this space, which isn't necessarily the worst thing, but it actually means that you've got to evangelize your product, which costs a lot of money on the marketing side. But if there are competitors, you should understand intimately yourself from a value proposition perspective and be able to articulate how you're unique from all of the competitors out there, how you will differentiate yourself against these competitors, and how you will market to the audience that you identified earlier. Purpose, audience, category, significance, and uniqueness. If you go through all of this from a framework perspective, and this takes time, this is work, and if you articulate this with your wives, your significant others, your husbands, etc., you will actually have a value proposition that helps inform a choice for employees to join you, for customers to buy product, and also for yourselves to determine whether or not you should actually build this company. Is this company worth building? It's a question you should ask yourself. Any questions so far? Yeah.
So what about the team?
We'll get there. So that actually. Yep, that actually, so again, we were talking about the value proposition of the product and not necessarily the value proposition from an investor perspective. But that's a great segue, thank you, for what do investors care about? First thing we care about, team. Second thing we care about, market size. Is this a multi-billion-dollar market? And third thing we care about is plan. Some investors care more about market versus team. Some investors care more about product and plan versus team versus market. But the framework that a lot of investors use for investing is team, market, and plan. You got a question? No? So let's talk about these. So team. To me, this is incredibly important. The team is actually the underpinning of the company, not the product, but the company. And the question that I ask is, does your team have an unfair advantage in the market that you're going after? I'm an enterprise investor, which means that I look for people that have deep experience, domain experience in a space where they can actually outwit and outrun any other competitors in a space. For example, networking or storage or cloud or mobile. So do you and do your team have an unfair advantage over any other team that will come together? And teams are generally, in many cases, cross-functional. What that means is there's a person who's very, very strong on the technology side in the IT space, and hopefully someone who's very, very strong on either the product or the business side. And in some cases, there might actually be an engineering leader that comes in who's very adept at hiring people and building. We've seen teams of 1, we've seen teams of 2, we've seen teams of 3, in some cases teams of 4 or 5, but founding teams tend to be relatively small, 1 to 3 people. I personally prefer to see at least 2 people, because this means that there's 2 people who've the opportunity to brainstorm with each other, who act as foils to each other, and who actually have complementary skills and skill sets. And hopefully both have an unfair advantage in the space that they're going after. Second thing we look for as investors is the market. You'll hear this over and over and over again in the Valley. We look for multi-billion-dollar markets. And the reason for this is relatively simple. Very, very large markets let you make mistakes, let you zig and zag and pivot, and also let you compete. If you're in a huge market, you only need to get 5-10% market share to actually create a very, very interesting company. If you're in a smaller market, $100 million, $200 million market, well, to create a public company, you actually almost have to have a monopoly in that space. And that becomes very, very difficult over time. And be honest about what your market opportunity is. One of the mistakes that I hear entrepreneurs make is, well, I'm in a $3 trillion Internet of Things market, to pick on something, right? Well, if it's $3 trillion, then you haven't actually identified who you're selling to, you haven't actually identified what you're selling, and you haven't actually identified what's unique about you. If you're in the storage market, which is $30 to $40 billion, are you the storage software? Are you a storage system? Are you a storage component? Are you storage management? Are you storage services? Again, it's very, very important, and very important for us as well as for you to understand how large your market is. If you kid yourself and you tell yourself you're in a $10 to $15 billion market, well, you may spend 3 years and $30 million building a product, only to find out that the segment of the market that you're going after is relatively small. So be honest. And the last thing is the plan and the product. What this means is, if you've got an unfair advantage as a team, if you're competing in a very, very large and hopefully growing market, well, do you have a plan and a product to put out a product in a, call it, reasonable amount of time for a reasonable amount of capital? And then once you've built it, do you have a plan to actually get leverage over time? So I personally don't like to invest in services companies, consulting companies. The reason for this, not only including the fact that you only get 1 to 2 times revenues from an exit perspective, but also The reason I don't like services companies is you scale with people. I prefer to see companies that scale over time with an upfront investment in software or hardware, and then the revenues start to outpace, from a gross margin perspective, the costs. So in a services business, to get more revenue, you have to add more people. In a software business, as you get leverage, as the flywheel starts to spin, as your sales team starts to get effective, your revenues can grow much faster than your costs. That's what I look for. What I look for from a sustainable leverage perspective is high gross margins. 60, 70, 80, 90% plus. I also look for a reasonable plan to get to revenue. When I'm doing a Series A investment, I don't necessarily look for how long it'll take you to get to cash flow break even, but I do look from a, call it, finger up in the air perspective, is your plan reasonable? Will it take 3 years, 5 years, 10 years to build your product, or will it take 18 months to 24 months to get your general availability? And then do your revenues actually make sense, or your revenue plan, does it actually make sense? I've seen some companies come out with plans that go 150, 200 million in revenues. If you could do that, fantastic, but it's very, very, very rare. In more cases than not, in the software and hardware spaces, you can probably go 1, 8 to 10, 25, 50, 80, and then hopefully you're public. So again, what do we look for from an investor perspective? Team, markets, and plans. So now that you've got your investor value proposition together, and you've also put some time into figuring out what your value proposition from a company perspective is, you need to get your first meeting with a venture capitalist or with a seed investor or with an angel investor. And your goal should not be to get that check on the first meeting. Very, very rare do we have a first meeting and write a check immediately. Your goal should actually be to get the second meeting. In many cases, you'll meet with 1, maybe 2 partners in the first meeting. The second meeting is where we start to dig in from a diligence perspective, where we start to dig in from a work perspective, where we include more of our partners. So your goal as a company seeking capital is to get to the second meeting. What really matters in the meeting, the first meeting, is first impressions. So the first 3 minutes, maybe 5 minutes, really matter. And this is where all the work that you've done in and around value proposition as well as investor value proposition come to bear. This is where you've got 3 to 5 minutes to impress us that you've got a team that has an unfair advantage. You're going after a huge growing market that is ripe for opportunity, and you've got a disruptive product with a plan that absolutely makes sense, and that we can that will turn into a category-defining company. Which brings us full circle back to, why does the value prop really matter? All right, remember we spent all that time on purpose, audience, category, significance, and uniqueness. Well, out of that will not fall necessarily immediately your investor value proposition, but that will form the basis for your elevator pitch. What Chad was talking about earlier, you probably have all heard about the elevator pitch. Too often I hear elevator pitches that go on for 2, 3, 5 minutes. Focus on getting it down to 30 seconds. Be absolutely clear, be absolutely concise, and use those 5 components of the framework to form the elements of your elevator pitch. We're building A, selling to B, and we're uniquely differentiated, and by the way, we've got some social proof in and around it. I've said this already, simple, concise. And what's really important about the elevator pitch is not only is the elevator pitch used to get a first meeting, which hopefully will be used to get a second meeting, but over time, the investor may start using that elevator pitch to form the basis of an investment thesis, and ultimately use that elevator pitch as the basis of pitching his or her own partners. Remember, we have to sell internally also. So if you have gone through the rigor of going through your your value proposition, your elevator pitch should fall out of that, as well as the investment thesis, and ultimately your investor value proposition. This is a pretty bold statement, but I would argue that all an investor needs to know about your business falls out of your value prop. Again, what is it you do? Who are you selling to and who are you marketing to? How are you different? Who do you compete with? And why does this matter? Right? These are the 5 things that we as investors need to worry about. These are the 5 things that you as an entrepreneur, as a company founder, need to worry about. And these are the questions that investors will ask you, that potential employees will ask you, and also that customers will ask you. So make sure that you spend time on this, make sure you articulate it, and make sure that it is concise and simple, easy to understand. So that's all I've got on investor and company value proposition. But I'll spend a little bit of time just walking you through venture math. And one thing that I think it's important for everybody here to understand is how we think about investments. So from a Series A perspective, venture capitalists tend to sort of cluster, and this is sort of rule of thumb, but not necessarily hard and fast. We look for somewhere between 20 and 30% ownership at the Series A. This is the highest risk place to invest from an institutional capital perspective. What we're looking for is over a 7 to 10 year period, and it really does take 7 to 10 years to build a company, is a 10 to 20 times return on our total invested capital. Which therefore means that we're looking for a $500 million and up. Today we're talking about unicorns, $1 billion value for your company. Well, if you've built a company that has sustainable leverage, that has high gross margins and is potentially public, well, even at 10 times multiple, you have to create a company over the next 7 to 10 years that has over $50 million in revenues annually. So what you need to think about is, as you work through your value proposition, as you've thought through purpose and category, uniqueness and audience and significance, can you build a company that in 7 to 10 years can actually get to $50 million in revenues? Some can't, some can, some can't. It's okay if you can't, but then if you cannot, then don't necessarily go down the path of venture capital, because it doesn't end well for everybody. If you can, then come down the path and talk to venture capitalists. But a little bit about your odds. So last year we evaluated roughly 5,000 deals. Took 10% of those through diligence. Took 10% of those to the vaunted one-day partnership meeting where the entire company, the entire firm sees the company. And then there was probably a relatively high fraction of that we actually invested in. But of 5,000 deals that we saw a year, we only saw 50 at the partnership level. So this sort of tells you how rare, notwithstanding the fact of all the stuff you read about in TechCrunch or on GigaOM or the other blogs, this tells you how rare it actually is to get an investment from a venture perspective. Individual partners tend to do anywhere between 1 and maybe 4 at the extreme end, 1 to 4 new deals a year. So when you're pitching a partner, that partner is thinking, is this one of the 1 to 2, maybe 1 to 3 deals that I will invest in over the next year? It's important to have that mindset. So with that in mind, how do you convince a partner that you are one of the, call it, 2 deals that partner will invest in that year? You have to have a process. You have to have pipeline. You have to deal with venture capitalists the way that you would from a sales process. Have a pipeline, iterate, keep people in the loop, seek feedback constantly. If that first meeting doesn't necessarily get you the second meeting, ask what would take you to the second meeting. To keep people held abreast of sort of your progress over a 6 to 12-month period. Help people understand what your milestones are and how, over time, you're actually achieving your milestones. And then the final thing I'll throw up there is just sort of, how to get to know. Biggest mistake people ask for an NDA. We see too many deals in too many geographies to be able to sign NDAs. I mean, we're not in the business of looking for ideas, but brilliant entrepreneurs come up with the same ideas at the same point in time. It constantly amazes me. The transistor was invented on the East Coast and the West Coast at the exact same point in time by 2 different teams. Don't talk about exit strategy early on, because that means you're focused too much on trying to get capital. You're focused too much on trying to work on the next thing. Focus on building a business, not on exiting the business. Don't think too small. Don't ask for a term sheet ahead of diligence, and don't focus too much on valuation. If it's the right partner, we will do you right. That's everything I've got. I think we've got maybe 3 to 5 minutes for Q&A before I'm yanked. Yeah.
So, regarding market sizing, when Uber launched, it was basically using black car services that already existed to take people around while. So that was only a service for black car services. However, obviously the vision was much greater as we see today. The size of the market for Uber in San Francisco was 3 times the size of the actual taxi industry in San Francisco. So if I was this founder of Uber, I would come to you and pitch. What pitch would you actually think is actually reasonable in market size, or what would be too far up in the stratosphere and be not acceptable?
Yeah, so the question is, how do I think about market size and using Uber as an example? Well, that's a tricky one, and we've seen some of those pitches, and the pitches sort of go down the path of painting a picture of the long-term vision. Not necessarily starting with just black cars, but actually starting with taxis. And if you start with taxis as a baseline for how large the market is for Uber, just taxis, worldwide it's actually a pretty huge market. And then what they were able to do was actually incentivize increased behavior, which increased the size of the market. But with taxis and black cars together worldwide as a baseline, I would argue that was a huge enough market for an investor to get involved. And obviously Travis painted a very, very long-term vision of what he wanted the company to actually be.
Related to that question, how do you deal with like first-time entrepreneurs that might not be so polished with this stuff, but they're really going after a huge market?
Yeah, we don't necessarily look for polish. I think it's really it comes down to the team, and it comes down to drive, aggressiveness, competitiveness, and an unfair advantage. Yeah.
You mentioned a minute ago a 7 to 10 year horizon for the company to actually grow to the size where you can have an exit strategy. But at the same time, I think your funds tend to be around at a timeline and a time horizon of 5 years. So that seems to be a mismatch.
Sorry, what's the?
So if when you get a fund, like you said, you have $1 billion fund currently, right? Doesn't that have a 5-year horizon?
No, we've got 10-year funds with options to renew every year thereafter. Yes.
For an early stage entrepreneur, how many VC interviews, first property, should they be planning? 10, 20,
Wow.
100?
I think what's really important here is figuring out, before you have a VC meeting, is figuring out who are the VCs that are probably most likely to be interested in your space, in your category. Target those, get warm introductions, don't necessarily throw cold emails out there, get warm introductions through your network and through their network to them, and set it up as something, looking for informal feedback unless you've got a full pitch ready. It's not necessarily, it's not like go after the people who you think will probably have the highest likelihood to convert. Probably last question. Yeah.
Following on with that, can you tell us how to find the investors in the particular space?
How do you find the investors in your space? Well, there's a lot of information out there. There's a lot of there's generally a lot of information. So you saw my bio. My bio is up on my webpage, right? There's every single venture capital firm has a webpage, with the exception maybe of Benchmark, and each of them have bios for each individual partner, as well as descriptions of what spaces the venture firm is interested in, right? There's some venture firms that focus exclusively on life sciences. There's some that focus on enterprise, some that focus on consumer. Those that focus on enterprise and consumer, you want to figure out who within there is a good fit for your company. And some of that is existence proof in terms of investments that they may have already made. So unfortunately, that's all the time I've got. Thank you so much. I'm easy to find. I'm, let's see here. There's my email address and my Twitter handle. Thank you so much.